Imagine it's 2027. You're scrolling through property listings and the house that you could have bought in 2025 for 300,000 is now selling for 400,000 pounds. You had the money and you had the opportunity, but you waited because you thought prices might crash. Now you're stuck paying way more money for the same house. Or worse, you're just priced out entirely. This is the exact fear that many investors have right now. Some are convinced that this is a once-in-a-decade buying window. Others are worried that a major crash is coming in 2027. So what's the truth? And more importantly, what should you do? Well, that's exactly what I'll be answering in this video. But first, let me paint you a picture of what's been happening in the UK over the last 18 months. Last year, I had tons of investors coming to me convinced that the new Labour government would completely crash the housing market. And some even panic sold their houses. But instead of a crash, we actually saw some pretty solid growth. House prices grew by 4.7% on average, which means that if you bought a £300,000 property last year, you've probably made about 14,100 in capital growth alone, and that's not even counting rental income. And the wider economy's been pretty interesting too. While economic growth has been crawling at a bit of a snail's pace, about 0.1 to 0.5% per quarter, the FTSE 100 jumped nearly 6% in 2024, showing that there's still plenty of confidence in the market. Banks like NatWest and Barclays recorded record-breaking profits, which means that they've got money to lend. And we've also been seeing some pretty major shifts in government policy as well. The Renters Reform Bill that everyone's talking about is going to drastically impact how landlords can manage their properties, and it sounds like there could be some really big changes to the planning system. But all of this has created a property market that is just more complex than anyone actually expected. And that brings us to where we are now in 2025. First off, the Bank of England base rate has just dropped to 4.5%. And in theory, that should be great news. For buyers, there's low rates, which means cheaper borrowing, right? Well, it's not always that simple, because banks are getting a lot stricter with who it is that they're lending to. And while most are happy with 25% deposits, some are now needing 35%. And even if you've got the deposit, banks are scrutinizing absolutely everything. Stricter stress tests, looking at rental yields more aggressively, and in some cases, they're just straight up refusing to lend if values feel a little bit unstable. But despite all of these things, analysts are calling 2025 a buyer's market because there's more properties for sale than we've seen in years. There's more developers, investors, property entrepreneurs, house flippers than we've ever seen before, and providing more and more stock to the property market. This means that sellers are now having to compete for buyers and not the other way around. I'm already seeing this play out. Rightmove has just had its busiest Boxing Day ever for new property listings. More sellers are offloading homes, and for buyers, that means that there's less competition and more leverage. But does that mean prices will actually drop? Well, not really. House prices are actually expected to rise by another 3% this year, which is not a huge jump, but it's enough to make some buyers rethink waiting to buy. So with more choices for buyers and property prices still climbing, does this mean that 2025 is the right time to buy? Now, to answer that, there's something pretty important that you need to understand. When the market crashed in 2008, most people thought that it just came out of nowhere. But one economist, Fred Harrison, had been warning about it for years, and what's even more fascinating is that he predicted the 1992 crash and the one in 1974. So how is that actually possible? Well, he discovered something called the 18-year property cycle, a pattern in the housing market that has repeated itself over the last 300 years. And here's how it works. The cycle begins after each crash, and the market takes about 4 years to find its feet again. Take 2008, for example. After the financial crisis, house prices didn't start rising properly again until about 2012, in some cases 2014 in some areas. And during this phase, banks start lending again, but pretty cautiously. Confidence returns, but obviously a bit slowly. And once the market stabilizes, we enter the 6 to 7 year period of just steady growth. This is when most investors make solid, predictable profits. Between 2012 and 2019, for example, property prices consistently just increase, and not at crazy double-digit rates, but at a pretty steady and reliable pace. And during this phase, more people jump into the market as confidence grows, house prices rise gradually but consistently, and the economy feels stable, and property looks like a pretty safe bet. But then, around the 9th or 10th year, the market has a wobble. Not a full crash, just a short downturn. You can think of it more as like a warning sign. And guess what? It happened right on schedule in 2019. House price growth slowed and buyers became a bit more cautious, and there was a brief drop in demand. But this dip didn't last long. It's the market catching its breath before the final sprint. After the mid-cycle dip, the market surges again, but this time it's different. Prices start rising faster than before, and people rush to buy because they think property will only go up, only for it to then come crashing back down. And that's exactly where we are in 2025. I mean, we can already see this playing out. Prices have been aggressively climbing since like 2020, 2021. Demand is still high in many areas, and there are lots of speculations. This means that if you're buying property now, you need to be pretty careful. Because if Harrison is right again, house prices will peak and then a crash will hit in 2027. And if it follows past cycles, we could see house prices drop 20, maybe even 30% in the worst hit areas. Which brings us on to the question that's probably on everybody's mind. Do you buy now or do you hold out for the crash? That depends entirely on the kind of investor that you are. If you plan to hold onto your property for 10, 15, 20, 30 years, then time in the market matters a lot less than you actually think. Let's say you buy a house in 2025 for £300,000 and the market crashes in 2027. And the worst case scenario happens and prices drop 20%, meaning the property is suddenly now worth £240,000. But if you fast forward 5 to 10 years, prices will very likely rebound and surpass any previous highs that we've had. By 2035, the same property could be worth £400,000 or more. And if you're renting it out, your tenants will have been paying down your mortgage the entire time. So if you find a great deal in a strong location with strong rental demand, buying now could definitely still make sense, as long as your finances are solid and you're not banking on some short-term appreciation. But if your goal is to flip properties or make just some quick profits, then timing becomes much more important. Harrison's model suggests that prices could climb another 15% before the crash. And if that's true, you could buy at £300,000, ride the increase to 345, and then sell just before the market tanks. Now that sounds great, except almost no one gets the timing exactly right. And if you miscalculate it and the market dips earlier than you expect, you could be stuck holding an overpriced property right as the demand starts to dry up. So if you really want a simple way to make sure that your numbers stack up on your deal, you can download the free investment calculator that's in the description below. But even if you wait until 2027, when that same property could drop to £210,000, you'll be facing another issue: banks tightening their lending. During crashes, cash buyers dominate the market and mortgage approvals just become way harder to secure. The people who win in downturns are the ones who've been sitting on cash that are just ready to strike. But before you make a decision, I want you to keep this in mind. While this 18-year property cycle has been incredibly accurate, the 2027 crash is still just a prediction. And right now, we've got rising interest rates, unpredictable government policies, the global economic uncertainty that could completely throw off the whole cycle's timeline. Could the crash come earlier than expected? Absolutely. Could it be delayed or less severe than people think? That is also definitely possible. So instead of trying to time the market, the real key is to figure out your goal, your financial situation, and how long you can afford to play the waiting game. At the end of the day, there's no one size fits all answer, but the biggest mistake you can make is simply doing nothing because of fear. I mean, so many people didn't get into the property market when COVID hit and it caused everybody to be terrified of buying. They were convinced the market was going to crash and it just didn't. Prices just skyrocketed. So these things are always a prediction, not always a guarantee. However, in 2025, there are a few cities that should be avoided because the short and long-term growth just doesn't look good there at all. So if you want to find that out, you need to check this video out next to see exactly which cities they are.